So if you check your retirement plan through your job, you probably have something called a target date fund. It's that mutual fund and it has a date in the name of it. It's the date that you're supposed to retire. Well, we're going to break down some of the issues with target date funds. You don't want to miss today's episode. Welcome back, guys. Super stoked that you're here. If you like today's content, be sure to hit that like and subscribe button so that you keep getting content just like this. And of course, if you need help with your own financial plan, you need help with taxes, investing, retiring, whatever it may be, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. We'd love to help you out. So target date funds are one of the most popular and most utilized investment options in the United States, without a doubt. If you're not familiar with what a target date fund is, a target date fund is a mutual fund that is, in theory, supposed to invest based off of your retirement date. So let's say that you picked let's just pretend that Modern Wealth creates mutual funds. So let's just say this is a Modern Wealth target date 2040 retirement fund. And you would see it in the name. It'd say 2040 retirement target date fund or whatever, something like that. So with this fund, if we were to put money in it, it's going to invest as if we have a target retirement date of 2040. And what that means from a portfolio management standpoint is that you are going to see the risk in the target date fund be dialed down slowly over time. It's going to follow something that is called a glide path towards that target retirement date. So it's going to get more and more conservative. And by conservative, I mean it's going to invest in things like bonds that have a lot less growth potential, but are safer over time. So in theory, if you're 30 years away from that date, it should be almost exclusively in stocks, almost 100% in stocks. But as you get closer, let's say that you are 5 years away from that target date, it's going to be maybe in 40% bonds and 60% stocks. And again, the whole idea behind this is it's trying to dial down risk slowly over time. So before I dive into the issues with this type of structure and target date funds, let me make something very, very clear. Target date funds, I think for a lot of people, especially if it's a default investment option, you don't know what else to pick, and you just pick the target date fund that was, aligns roughly with your retirement date just because you didn't know what else to pick. You're doing better than a lot of folks, right? I mean, it's one reason why for Modern Wealth, when I was designing the 401k plan for our employees, we have target date funds as the default investment option when someone automatically enrolls into the plan, right? It certainly is better than just having your money go into a 401k plan and not do anything. No doubt about it. But in my opinion, I believe that there is a more optimal way to generate more return over time. And we're going to break that all down today. So on its surface, target date funds sound like a pretty solid investment choice. But here are the issues that I have with target date funds. First and foremost, target date funds tend to dial down risk too early for my own liking. So prior to recording this episode, I went ahead and took a look at a handful of 2040 target date retirement funds from a handful of asset managers. So this is 2024 when this is being recorded, so 16 years out from retirement. And what I found inside of these target date funds, 16 years out from retirement, again, with a 2040 target date, they had on average around 20 to 25% bond exposure in them, right? 20 to 25% bond exposure. And we're that far out away from retirement. That, in my opinion, is too conservative, right? Especially if you can handle the risk. Again, risk is all in the eye of the beholder, right? A 20, 25% bond exposure might be, too much risk for some people. But I think for a lot of folks, especially if they are working, they're actively contributing to their retirement plan, and they truly are not going to retire for another 15 plus years. Most people, from my experience, are pretty good at handling volatility in something like a 401k plan that would have this type of investment option. And so with all that being said, if we're adding 20 to 25% bonds in the portfolio, that's over time is going to be a drag on the portfolio. Your returns are over time going to be watered down, because the reality is that a well-diversified 100% equity portfolio is over a long period of time going to outperform a bond-oriented one. And in addition to that, the types of bonds that we're utilizing, because again, bonds can come in many different flavors. The vast majority of the bond exposure within these target date funds, once they start adding them to them, are highly conservative forms of bonds. So we're talking things like, government-backed bonds, treasuries, things like that. That's going to be the lion's share of the credit exposure. And so that is, again, a drag on the portfolio, and it's unnecessary. And I see this happen all the time. And it's one reason why, if I know someone is a ways out from retirement, or they can handle the risk, why slow down the returns and muddy the waters by throwing bonds into the mix too early? So that's my first issue. The second issue that I have with target date funds is that not all of your retirement accounts or your retirement buckets that you're going to be dipping into for retirement are built the same from an investment standpoint. So let's just use a somewhat simple example to try to bring this point home. So let's say that you are 55. You're 55 years old and you plan on retiring at 60. So you're 5 years out from retirement. Let's say that once you retire at 60, you would like to draw down some of your investment portfolio. And your overall investment portfolio is worth $1 million. You have $500,000 in pre-tax accounts like a 401k. You have $250,000 in a Roth, and then you have $250,000 in a taxable brokerage account. So you got these three buckets to dip into, and you're 5 years out from retirement. When you retire, let's say you go ahead and you tap into your pre-tax retirement bucket first. You're going to tap into that bucket first because you're not going to be drawing Social Security. You have no other forms of income. So you're going to draw from that bucket first because your taxable income is going to be very, very low, right? Sounds pretty logical. And so as a result, you are going to invest more balanced or more conservative in that pre-tax account that you're going to be dipping into. Okay. Very reasonable, very common setup. Now, let's say that if you need to supplement some of your income, maybe an unexpected expense pops up, or you just want to manage taxation a little bit. So you are going to draw from your taxable brokerage account or your savings accounts in addition to the pre-tax account. Okay, so you're drawing from those two buckets at 60. And as a result, that taxable brokerage account bucket, we're going to invest in a more even-keeled, more moderate, conservative way, let's say. Okay. Well, what about the Roth account, right? I mentioned there's $250,000 in a Roth. What are we going to do with that account? Well, that Roth account, that's where we are going to invest more aggressively. We're going to juice the returns a little bit more because we actually don't want to touch that Roth account for another 10 years. we may have retired at 60, but we actually plan on touching that Roth in our 70s, way later down the road, let's say. If that is the case, right? If that is the case, and let's say that we just slapped a target date fund across the entire portfolio, or for that matter, we even just said, all right, I'm a 60-40 moderate investor. I'm just going to go ahead and invest across the board that way. If we did that, we're inherently dragging down the overall return of the portfolio for no reason. That might work in the brokerage account, in our pre-tax retirement account where we're dipping into. Maybe it makes sense to have that more even-keeled approach. But in the Roth, if we're not going to actually be touching it, and we could actually be spending more time investing it and letting it cook in the oven, we might as well be more aggressive with it. And a target date fund would slow us down in this example. So that's my other issue with target date funds, is that not all of your retirement buckets are going to be invested with the same asset allocation. And that's kind of the approach that target date funds take, especially if you have a retirement plan where you have some Roth money in it and pre-tax money in it. The final issue that I have with target date funds is, of course, the lack of customization with the overall asset allocation in them. I mean, this in reality could be a separate episode in itself, but to try to make this brief, with the stocks in the target date funds, you are looking at more large cap oriented exposure, right? You're going to have a cap weighted indexes at the core in all likelihood, and you're going to be tilted towards large cap companies. There's nothing wrong with that, with having large cap oriented exposure at the core of the portfolio. The problem is that, and again, this is especially relevant for folks who are maybe 10, 15, 20 years away from retirement. We know over long periods of time, asset classes like, let's say, small cap, right, that have much more growth potential over long periods of time can potentially outperform large cap. And so if that's the case, why wouldn't we want to tilt more to those types of stocks? If we wanted to do that, we really couldn't do that with just a plain old target date fund. Again, that's just one issue, right? If you wanted to explore different types of equities, right? Maybe you truly are about to get to retirement and you want more dividend oriented stocks in the portfolios, spitting out dividends so that you can start to live off the cash flow, right? There's no way to design that with a target date fund. Again, it's pretty vanilla. The other issue, and I kind of mentioned it before, is regarding the fixed income or the bonds in the portfolio. The bond exposure that you are going to have, oftentimes, if you pop the hood open and look at the types of bonds they're investing in, it's mostly treasuries, government-backed bonds, right? Very, very conservative. And while, yes, bonds are supposed to be a stabilizer in the portfolio, you can still take a conservative approach with bonds, but maybe dial more into, let's say, corporate bonds that have higher returns and a similar risk profile to spice it up a little bit. Again, nothing crazy, but that could juice the returns. But you don't have that type of flexibility with a traditional target date fund. So I've talked about some of the issues with target date funds. And so if you have listened to this point, you're thinking, all right, well, what are the alternatives if I wanted to ditch my target date fund in the retirement account that I have? What should I look at? Here's some things that you could consider instead. So number one, if this is a retirement plan through your job, right, and there's a predefined investment menu that you can pick from, take a look at that investment menu. Oftentimes, these plans will have asset allocation options that are different from a target date fund. So what I mean by that is sometimes there'll be an aggressive allocation option. And what that means is that aggressive allocation option might be 100% stock exposure. It's not going to dial down slowly over time. If you know, hey, I want 100% stock exposure, don't start sprinkling in bonds and slowing down the returns, then maybe something like that is more your speed. On the flip side of that, heck, maybe the target date fund is too scary for you and you want a more conservative option, then maybe maybe that asset allocation option, like a more balanced fund, would be available instead. Again, it works both ways. So take a look for those asset allocation options within the plan. Now, maybe you don't have asset allocation options like an aggressive fund or a balanced fund or whatever it may be. They just don't exist within the confines of that plan. Well, if that's the case, take a look for broadly diversified index funds within the fund menu. Sometimes you'll have like a total market index or total international stock market index. You'll have some emerging market funds, right? And with those different pieces of the puzzle, you can effectively create your own aggressive allocation with those pieces. Again, you have to take a look at the menu and piece them together, but I would bet that you might have some flexibility there. So the third thing that you can do instead is that you can take a look at self-directed options within the 401k plan or retirement plan that you have. Not all plans have this, but a lot of them do. So for example, Fidelity has something called Brokerage Link. What Brokerage Link is, it's a separate account within your 401k plan. So it's still technically part of your 401k. It's still tied to your 401k. And within that account, pretty much the entire investment universe is open to your disposal. Stocks, ETFs, mutual funds, etc. If you have that type of option within your plan and your investment menu is pretty limited, it doesn't allow you to take a more aggressive, diversified approach. If that's what you're looking for, perhaps you can do that through the self-directed option if it's available to you. So take a look at that, because that might be your key to optimizing returns a little bit more. Again, I really want to stress that target date funds, if you are just frozen or you're scared to make a change, and you currently have a target date fund within your retirement plan, I still believe for most people that's better than nothing, and that's better than 80% of the options out there, right? I mean, I've seen people ditch the target date fund and just invest in gold, 100% of the time, right? I mean, if you've been doing that over the last decade, your portfolio has been in a pretty rough place, right? So obviously it's not perfect, but I truly believe that if you do have the comfort and you want to optimize a little bit more, there are better ways to go about it. If you want to try to implement this approach within your own portfolio, if you're looking to optimize your own retirement plan, reach out to us at www.modernwealth.com. That's modern spelled with no vowels, wealth.com. Been a ton of fun, guys. We'll see you next time.